morning, everyone. Thank you for joining us this morning for this webinar. So it is bang on 11 o'clock. I'm sure we will still have some attendees joining, but in the interest of time, I think we will get started with the webinar. We do want to try and keep this as interactive as possible, so please do pop some questions in the Q&A or into the chat if you do have anything that you'd like to raise as we're going through. So maybe as a brief introduction, so I'm Vanessa Turnbull-Kemp. I'm Head of Outbound Structuring here at Regan van Rooy. My co-presenter today is Marcel Geldenhuys. He is an Assistant Manager in the tax team at Regan van Rooy. So thank you very much for joining us today. So today we're going to be taking you through all SA businesses need to know about internationalizing their business. So maybe a brief introduction to Regan van Rooy. So for those of you who don't know, Regan van Rooy is a boutique tax advisory firm. We specialize in international tax structuring and transfer pricing, as well as corporate SA tax, and as well as African tax. So essentially anything you need from a tax perspective, we at Regan van Rooy can assist you with that. Yeah, so let's jump in. So, I mean, I think the very first thing I think people will always want to know, apologies, I put my camera off by accident. The first thing people would always want to know is, okay, well, why should you consider internationalizing your business? You know, you might have a business in South Africa that's doing really well, that's growing, that's expanding, and now you're looking to say, okay, well, what's the next step? So some of the benefits of internationalizing your business is you're obviously able then to build up profits outside of South Africa. As I'm sure everyone on this call knows, South Africa does have exchange controls, which does making investments outside of South Africa, making payments outside of South Africa, a little bit more complex from a compliance perspective. There's always, you know, an additional little administrative loop that needs to be jumped through. So if you have an international hub somewhere outside of South Africa, you wouldn't have to worry about exchange control any longer. You can then also build up your profits in a hard currency. We all know that the rand does fluctuate up and down, you know, fairly rapidly. So if you've got a hub offshore, you can keep your profits in a hard currency like USD or euros, so you're not dealing with those fluctuations. This can also assist if you are dealing with offshore customers or paying offshore expenses, so you're not having to do all your exchange gains and losses, etc. If you internationalize your business, depending on how you set it up and where you set up your international hub, there could also be greater tax advantages to the group as a whole. For example, if you set up a group holding company, or if you set up an entity offshore that can do certain activities for the group, that could be taxed at a lower rate, or could even get tax holidays or tax incentives. And the other, you know, one of the bigger reasons why we do look at setting up international businesses is it's a nice platform from which you can do further global expansion offshore. And it's also then a nice way if you're looking to sell your business at some point in the future, or if you're looking to bring investors into the future, which are not necessarily based in South Africa, having a global hub or a global business entity within the group can actually make that a little bit easier to do. So there's various reasons why you would consider internationalizing your business. Something just to bear in mind is when it comes to looking at how to internationalize your business, we shouldn't always only look at the tax aspects. It has to be commercially viable for the business. So obviously, you know, tax can't be your deciding factor. You need the commercial rationale, and then, you know, we can consider the tax as an add-on to your commercial advantages as well. If we go on to the next slide. So these are, what we've put on this slide is some typical structures that we normally see that businesses can consider when they're looking to internationalize their business. Now, as you can see, we've got 3 on this slide, but there are many different types of structures that can be considered depending on your needs. So the needs of the shareholders, the needs of the business, as well as, what does your business actually entail? Where do you have customers? Where do you pay expenses? And what actually does your business do? So there's various different types of structures that can be considered. The three that we've put on this slide are some of the more common or typical structures that you probably would have seen out there, that can be considered. So as you can see here, we've got two examples that do have a foreign trust in the structure, one that doesn't. Now you might be saying to yourself, okay, is a foreign trust always necessary in a foreign structure, or if you want to put in place an international structure? The answer to that is no. It's definitely circumstance driven, and it really depends on what you're trying to achieve, and also the value of the business and where your shareholders are located, for example. From a South African perspective, if you've got an owner-managed business or a company that's owned by individuals at the end of the day who are South African tax resident, a trust can bring in a lot of advantages for those shareholders. So I think, as most people will know, a foreign trust, you can obviously keep all your wealth offshore. You can then have all the profits coming from the structure into that trust, where it can then be invested for wealth generation or for retirement purposes. But additional benefits for a foreign trust is that it does act as a so-called CFC blocker. That's not an official term, it's just a nice way to explain it. So a CFC, for those who don't know, is a controlled foreign company. So if you've got South African residents who hold either alone or jointly more than 50% of the shares in a foreign company, then that foreign company will be known as a controlled foreign company for South African tax purposes. And essentially what that means is, depending on a couple of factors, is that the profits from that foreign entity could be imputed back into South Africa to be taxed in the hands of the South African shareholders. There are obviously exemptions and exclusions that could apply to that, but that's as a general rule. So if you have a foreign trust interposed between the South African shareholders and the foreign company, then you don't actually have to worry about those controlled foreign company rules going forward. So that can be a big benefit. The other benefit of putting a foreign trust in between South African resident individual shareholders and the foreign company is that it does break the link from a South African estate duty perspective. So for the South African shareholders, essentially the value of the shares that they own in that foreign entity won't form part of their estate for South African estate duty purposes. And similarly, if the shareholders ever immigrate from South Africa, the shares will not form part of their asset base from a capital gains tax exit charge. So if you immigrate, there's a deemed exit charge that arises on the day before you cease South African tax residence. And if those assets are then owned by a foreign trust, that doesn't apply to those assets anymore. Now, a foreign trust does seem quite beneficial, but there's also downsides to a foreign trust. Two main downsides that South Africans normally face is essentially when you have assets owned by a foreign trust, those assets do not belong to the shareholders anymore, or the original shareholders who are now beneficiaries of the trust. The assets actually then are held and owned by the trustees of the foreign trust. So essentially, you have to give away control that you would have had in the past. You give it away to the trustees. So, people don't normally like that. The other downside is obviously the cost of a foreign trust. Depending on what jurisdiction you establish your foreign trust in, you're looking at a cost of $3,000 all the way up to $5,000 or $6,000 per annum, depending on the jurisdiction, the amount of transactions going through that trust, and the management company that you choose to do that. So it really just depends on your circumstances and really what you want to achieve at the end of the day, whether a foreign trust is for your structure or isn't suitable for your structure. As you can see under the third example there, we do have that the individual, in this case, Mr. X, is holding the shares in the foreign entity in his individual capacity. Now, where you do have South African resident individuals holding more than 10% of the shares in a foreign company, in the individual capacity, whether alone or with other people, or even with other South African companies, as long as you hold more than 10% of the shares in that foreign company, any dividends that you then receive out of that foreign company will qualify for what's known as the participation exemption, which essentially means that the foreign dividends that you get out of that foreign company in South Africa will be exempt from tax in South Africa, provided the person who's receiving it does own more than 10% of the shares. Okay, when we go to the next slide, we'll show you that there is a caveat to that participation exemption if you're holding the shares through the foreign trust. Marcel, is there anything you'd like to add on this typical structures to consider?
Yeah, definitely. So anytime an SA resident looks to invest offshore and that offshore vehicle invests back into SA, it creates what's called a loop structure. So Vanessa, if you could perhaps elaborate on what is a loop structure, although I already briefly just explained it, and what does it mean for businesses looking to externalize in respect to the application that needs to be made to the Reserve Bank, etc.
Yes, so I'm sure everyone has heard the term loop structure. So essentially, as Marcel said, a loop structure is where you've got South Africans, whether individuals or companies, invest in an offshore structure, which then invests back into South Africa. So that's known as a loop structure because essentially the investment goes from South Africa offshore back into South Africa. Now, from an historical perspective, prior to, I think it was 2021, loop structures were not allowed. So from a Reserve Bank perspective, they didn't allow loop structures to take place. So if you wanted to do a structure such as this, you wouldn't be able to have the SA company at the bottom, essentially. So you'd have to have a South African structure, and then you'd have your foreign structure, and they'd have to be completely separate. Since I think it was the beginning of 2021 or 2022, loop structures are now allowed with a few caveats. So the Reserve Bank says, yes, you can have these investments where South Africans are investing offshore and back into South Africa, but you need to place it on record with the Reserve Bank. And there's a few requirements that need to be met. So essentially, there needs to be a benefit to South Africa. And you can't use South African funds to fund this loop structure. All right, so they have put a couple of caveats in place for that. But as long as you tick the boxes that the Reserve Bank has put in place, you are then allowed to enter into these loop structures. So the Reserve Bank doesn't say you need to go to the Reserve Bank and get approval. The wording that they use is you need to place it on record. And you place the loop structure on record after you've put your structure in place. So you would establish your whole structure, get everything up and running, and at that point, then you would go to the Reserve Bank through your authorized dealer, who is one of your local South African banks, and you would tell them, this is the structure I've put in place, this is how I've funded it, these are potential benefits back to South Africa because of this investment. You do have to prove to them that the foreign company has paid for those shares in the South African company or has paid to establish that South African company. And as long as you do that, then the Reserve Bank will normally respond to you and say, noted, we have placed this loop structure on record. Then there is just annual reporting that you need to do to just go back to the Reserve Bank to say, structure's still in place, no changes have happened, or if there's been any changes, you report those changes as they happen. So this was, I think, one of the biggest changes that actually came through the exchange control regulations in the last couple of years. I think it quite excited everybody when loop structures were allowed. And although it does come with a couple of caveats, they're very easy to work around. And to actually take into account in your structure.
Thanks, Vanessa. And then another very important consideration, I think, is if you decide you want to set up your trust, if you want to set up your company or your offshore structure as a whole, it's very important to consider how that structure is going to be funded. So generally, if you fund a trust, it's usually done by way of an interest-bearing loan. And the reason for that mostly is to mitigate the attribution risks we have in South Africa, firstly. And then secondly, the interest rate on the loan must be an arm's length market related interest rate. And the reason for that is to avoid the deemed donation provisions also contained in the South African Income Tax Act. So if you want to maybe elaborate a bit more on how those work, Vanessa.
Sure. So the attribution rules are not very fun and quite complex rules that is in our Tax Act. They're contained in Section 7 of the Income Tax Act. And essentially what those attribution rules say is if you have funded a foreign trust and you've done so by way of what's termed as a donation, a settlement, or other disposition, then any income which that foreign trust earns from that donation, settlement, or other disposition is then taxed in the hands of the settler. Now, a donation is obviously very self-explanatory. It's if a South African has now donated funds or assets to the foreign trust. There would be South African donations tax, first of all, paid on that. But then over and above that, so let's use an example. If a South African donates 10 million rand to a foreign trust, they're going to pay 20% donations tax on that donation. And then if the foreign trust uses that cash to invest in, for example, shares or stock portfolio, the income then that's earned from those shares or stock portfolio in the foreign trust will automatically be attributed to the South African settler and will be taxed in the settler's hands as if that settler had earned that income directly. All right, and that applies, those rules apply for the lifetime of the settler. Okay, so those are known as the settler charging provisions in the Income Tax Act. Now, the one nice thing about a donation is that once the settler passes on, if there's any other beneficiaries in that trust who didn't donate anything to the trust, then the settler attribution rules at that point will go away, and then we go to what's known as the beneficiary charging provisions, which I'll go into in a little bit. But essentially, if you're going to fund a trust by way of a donation, there's definitely going to be upfront donations tax, and then there's going to be tax implications on any income earned as a result of that donation. Even though it's in the foreign trust, which is in a different country, SARS will pretend as if the settler had earned that income directly, and they'll be taxed on that. All right, and the tax rate that applies would be the tax rate that would apply to that individual. So if it's dividends, the individual will be taxed at the dividends tax rate of a maximum 20%. If it's income, such as interest, the individual, or the settler in this case, would be taxed at up to 45%. So depending which tax bracket they fall into. Now, this also applies. So if it's not a straight donation, but let's say you funded the trust by way of an interest-free loan. Now, the interest foregone on that loan, so the difference between what should have been an arm's length interest rate, and let's say in this case there is no interest, so the amount of the interest that should have been charged is deemed to be a donation. So there's donations tax that's charged on that. And then over and above that, the attribution rules again apply, which means that any income that's earned from the trust as a result of that interest-free donation, limited to the actual interest foregone, is then taxed again in the settler's hands. Okay, so even if you are funding it by way of a loan, but that loan is not interest-bearing, or it's not interest-bearing at what SARS deems an arm's length interest rate, then unfortunately the attribution rules are going to catch you, and you're still going to be paying South African tax on that. Okay, as Marcel said, we normally recommend that you do fund the trust by way of an arm's length interest-bearing loan. Now, as long as you do that and it's considered arm's length, then your settler charging provisions are not going to apply, but what's called as the beneficiary charging provisions are going to apply. And essentially what that means is At the point that there's a distribution made out of the trust, so different to settler charging provisions, which say it doesn't matter when the trust makes a distribution, we can tax you as soon as the trust earns it. With beneficiary charging provisions, the rules say when there's a distribution made from the foreign trust, then we're going to determine how the beneficiary is charged. So now the settler's not going to bear the tax. It's going to be the settler who receives that distribution. And the tax treatment of that distribution will really depend on, first of all, the timing of that distribution, and then the nature of that distribution. So, for example, let's do something like interest, which is quite easy, regardless of when that interest is distributed out of the trust. The beneficiary who receives that interest is going to be deemed to receive interest, and they're going to be taxed as if they had received interest. So at their individual marginal rate, obviously taking into account the interest income exemption that could apply. Dividends is slightly different. So with dividends, the timing of the distribution out of that trust is very important. So with foreign dividends, let's say the foreign company distributes dividends to the foreign trust, and then the foreign trust immediately distributes those dividends to the beneficiary. Then what the South African tax rules say is the beneficiary is going to be treated as if they had received those foreign dividends. So they'd be taxed as foreign dividends at the maximum rate of 20%. Now, with a foreign dividend, distribution of foreign dividends through a trust can, in some instances, qualify for the participation exemption, as I described earlier. But there's a caveat to that. So as I mentioned, under normal rules, the participation exemption on foreign dividends will apply if you hold at least 10% of the shares in the underlying foreign company. Okay. Now, when you're looking at a foreign trust, you don't look at, okay, obviously, if the beneficiary immediately receives a distribution of foreign dividends from the foreign trust, the rules say you've got to look at, did the beneficiary itself hold more than 10% of the shares in the underlying foreign company? And the answer to that is no, because the beneficiary is just a beneficiary of the trust, and it's the trust that owns more than 10% of the shares in the underlying foreign company. So in that case, the participation exemption won't apply. Now, if you receive a distribution from the foreign trust in a subsequent tax year, so let's say, for example, the foreign company earned foreign dividends 5 years ago, which are distributed to the foreign trust 5 years ago. So the foreign dividends have been sitting in the foreign trust for a couple of tax years. Then the foreign trust distributes the dividends to the South African beneficiary. Then the South African tax rules say, okay, the beneficiary can get the participation exemption if the trust would have gotten the participation exemption if the trust had been treated as a SA resident. So then we'd look and say, okay, does the foreign trust own more than 10% of the shares in the underlying foreign company to determine whether the participation exemption applies? But there's a slight caveat to that, in that shareholdings held through the foreign trust in this instance, in order to qualify for the participation exemption, there's a cap on the participation holding, and that cap is at 50%. So essentially what SARS has done is to say, if the foreign trust holds more than 10%, but not more than 50% of the shares in the underlying foreign company, and the dividends are then distributed in a subsequent tax year, then the beneficiary can get the participation exemption on those foreign dividends. So if you look at the middle example picture that we've got there you can see the foreign trust owns 100% of the underlying foreign company. So if there were dividends flowing through that to the beneficiary, even if it's in a subsequent year, because the foreign trust owns more than 50% of the shares, the beneficiary unfortunately won't get the participation exemption, which means that the dividends that they receive will be taxed at the full maximum rate of 20%. But let's say, for example, the foreign trust held 20% of the shares in that foreign entity. Then dividends which are distributed to the beneficiary in a subsequent tax year to which they received by the foreign trust, then the beneficiary could have got the participation exemption. Okay, and really the rationale for why SARS did that is because if the individual had held those shares directly in the foreign company, like the third example we've got there, that foreign entity would be a CFC, a controlled foreign company, because it would have held, Mr. X in this case, would have held more than 50% of the shares. But in the second example, because the foreign trust is interposed, it breaks that controlled foreign company link. So SARS has then brought in this caveat to say, okay, well, because you've interposed the trust, you're circumventing controlled foreign company rules. And so any dividends that you receive via that then is not going to get the participation exemption if you own more than 50% of the shares. Okay, so that's really, really the rationale around that. I do want to point out one thing with this, though. So a lot of the times what people do is they do set up a structure that looks similar. Apologies, I keep hitting my spacebar. Most companies or most structures do set up something that looks quite similar to what's shown in the second example there. So you would have your South African beneficiaries who are beneficiaries of a foreign trust, which then hold shares in a foreign company, which then holds shares back into South Africa. Now, what people try and do is to get those dividends from the South African company, and they want to distribute it all the way back to the beneficiaries in South Africa. Now, it's important to note that those South African sourced dividends, if they flow through the structure, even if the beneficiary could have qualified for the participation exemption, the SA sourced dividends won't qualify for that. So if I use an example to say the foreign company is a pure holding company, it doesn't earn any of its own income. The only income it earns is the dividends from the South African company. So when dividends are distributed out of the South African company to the foreign company, now let's assume it's in Mauritius, so that the Mauritius-South Africa tax treaty applies. Dividends then that are distributed from South Africa to Mauritius would be subject to a 5% withholding tax in South Africa. So instead of the 20% that would normally apply, it's now at a reduced rate of 5%. Then the foreign company, the Mauritian company in this case, distributes those exact dividends up to the foreign trust. And then the foreign trust in a subsequent year, let's say, distributes those exact same dividends to the SA beneficiary. Now you might say, okay, the foreign trust has made a distribution of foreign dividends in a subsequent year, so I should get the participation exemption. Now, SARS tax rules say no. If it is South African sourced dividends that flow through that structure, you then have to pay a top-up tax in South Africa on the additional 15% that you didn't pay when they left South Africa in the first place. Okay, but if that foreign company earns its own income, then it wouldn't apply on those foreign sourced dividends. I hope that makes sense. Marcel, anything else you want to add on this?
No, I think while we on this topic, you briefly mentioned Mauritius and DTAs. I'm sure everyone knows that a DTA is a double taxation agreement, and it's entered into between two countries, and oftentimes it results in reduced withholding tax rates with respect to dividends, interest, royalties, and so forth. Also loads of other things, but for the purposes of this discussion now, let's just speak about the withholding tax rates. So you briefly mentioned Mauritius, Vanessa. So we all know Mauritius is a very popular jurisdiction for South Africans looking to externalize. Could you maybe just touch on when you decide you want to externalize, with regards to location, do you only look at double taxation agreements, i.e. where you can save on dividends and interest withholding tax, or are there other aspects that you also need to consider?
So there's absolutely other aspects that you must consider. We obviously do take DTAs into consideration when we're looking at this, but there's a lot of other factors that also need to be taken into account. So, I'm sure everyone here has heard, the term BEPS, which is essentially base erosion and profit shifting. And the OECD, which is an international body, has really been focusing on base erosion and profit shifting to try and prevent the scenarios where people are using jurisdictions like Mauritius, BVI, Cayman Islands to kind of shift profits to a low tax jurisdiction. So when you're setting up a foreign structure, it's very important to make sure that the jurisdiction that you choose for your holding company or to have as a hub or to have an additional operation in has to be underpinned by commercial reasons, first of all. So the jurisdiction that you choose must be commercially viable. There must be some kind of business rationale for why you're considering a certain jurisdiction. It also does need to be a jurisdiction that you do have to have substance in that jurisdiction. So the days of putting in place your kind of post-box companies are long gone, and substance is a very, very important aspect. So wherever you do set up a hub, you are going to have substance. You are at a bare minimum going to have to fly to that jurisdiction for board meetings. So it is somewhere you're going to be visiting fairly frequently. So that does need to be taken into account. So let's say, for example, you could have let's say you've got a subsidiary in the US, in America. Okay, then you might say, okay, the US has a high tax rate, so we want the dividends to go out of there to somewhere where we're not going to pay any tax. So then you might say, okay, well, let's stick a company in the Cayman Islands. Okay, now let's all be honest. Not a lot of people go to somewhere like the Cayman Islands on a regular basis other than for holiday or if you've got a post-box company. Okay, I think that's quite, there is obviously circumstances where there is business happening there, but, in typical, from a South African perspective, not too often. So, things like that are definitely looked at. So it could, if you're going to set up a hub in a jurisdiction where you don't have enough substance, or that has a reputational risk for being a jurisdiction that is only used for post-box types companies, you are going to face a lot of scrutiny. Your customers are going to ask questions, and you are going to have to then prove that you've got the required substance, you've got a legitimate business there, etc. So commercial rationality, business rationales does underpin everything. Then we do look at tax treaties to say, okay, if your subsidiaries are very profitable and you want to take profits out into a holding company, for example, we would always look at, okay, where can those profits go, which won't be very highly taxed, where there's a good tax treaty to reduce the withholding tax rates. But then alongside that, the things that we also look at would be, what is that foreign company going to do? What activities is it going to do? And then, where are the customers based? So, for example, that foreign company might own software, and then they're going to earn income from customers all over the world from license fees or royalties. Then we've also got to consider to say, okay, if your customers are paying you royalties, there could also be high withholding taxes that are being levied on those royalties. So then we've also got to take into account where are your customers based and the type of income that you're going to earn. So we do have to look at these structures from all angles, to be honest. Other things that we do also need to look at is, just like practical things. So, for example, some countries can be quite sticky from a KYC perspective for banking. In that case, sometimes if they see a group entity that's in a jurisdiction that doesn't have a very good reputation, or that's on the blacklist or the grey list, then you're going to have issues from a banking perspective. So, the bank's going to give you uphill then. So you might battle to open a bank account, or you might get requests for KYC documentation all the time. So there's also factors such as that we do need to take into account as well. The other thing we would always take into account is, where are your actual shareholders based, and where are your board of directors going to be based? Because as I said, you are going to have to travel there to that jurisdiction from a substance perspective. So if you want to have your holding company in the Cayman Islands, but your board of directors, you've got board of directors in South Africa and in Mauritius. Flying them to somewhere like the Cayman Islands is going to take them 3 or 4 flights, and it's going to be painful and it's not going to be fun. So it's things like that that always then also has to come into play. And as I said, I want to reiterate it again, it all has to be underpinned by commercial rationale. So you have to have a commercial reason. So if you do want your hub in the Cayman Islands, because let's say you've got board of directors who are living in the Cayman Islands, or your CFO or CEO is living in the Cayman Islands, then great. Then you've got a commercial reason for doing that. But that has to underpin all the decisions that are ultimately made around your structure.
And also, just to add to that, as Vanessa said, substance is of utmost importance if you want to set up a company. And that can be seen in the double taxation agreements itself as well. So Vanessa briefly mentioned the US. So the US has a very high withholding tax rate of 30% when dividends are distributed. So you can't go and they call it treaty shopping. So you can't go and look at, which jurisdiction has the best DTA with the US so that I can get that reduced withholding tax rate. So the US likes to put a limitation of benefits clause in their double taxation agreements. And essentially that clause focuses on substance. So for example, if you have a US company and you set up a UK company, for example, in that the UK has a nice DTA with the US. The limitation of benefits clause could result in you not qualifying for the treaty benefits, for the reduced withholding tax rates on dividends, for example. And that limitation of benefits clause also focuses on substance. So if I remember correctly, the UK company that you set up needs to have a shareholding of at least 50% of UK residents or US residents. And that again reiterates the importance of actual substance and to avoid essentially what is treaty shopping, to set up shop somewhere that has the best DTAs with the country you transact with. And then in addition to a limitation of benefits clause, is what's called the multilateral instrument that has been ratified by many countries. And essentially that also assists in preventing treaty shopping. So in the multilateral instrument, you've got the what's called the principal purpose test. And that test essentially means that if you only set up a company in a jurisdiction to qualify for the benefits under the double taxation agreement, then you won't be able to get those benefits. Or if the transactions you are concluding or the business you're doing is not in line with the spirit of the double taxation agreement, the reason why it was entered into. So I think, that's also important thing, very important things to consider when setting up offshore.
Yeah, okay. Thanks for that.
So let me just move on. I think Vanessa already touched on this, or actually spoke about it in quite some detail. So I think we can maybe skip this slide, Vanessa, or if there's anything else that you want to say about this.
Yes, so I think this is just a kind of illustrative example of what I was explaining on the previous slide, of how you can actually get the participation exemption for foreign dividends that are distributed to SA resident beneficiaries from the foreign trust. As I said, it would only apply if the foreign trust owns more than 10%, but less than 50% of the shares in the underlying foreign company. And again, it only applies if you meet those rules and the distribution is made by the foreign trust in a tax year subsequent to the tax year in which the foreign dividends were received by the foreign trust. So if you look at these two examples, under the first one, you can see the foreign trust owns 9% of the shares in the foreign company. So there, the foreign participation exemption won't apply. But in the second example, where there's a 49% shareholding, it would apply.
Okay.
I think just before we move on, so normally, I mean, a lot of structuring that we do get involved in is where you've got family businesses, or businesses that were historically founded by families. So a lot of the times they do like to structure through foreign trusts because obviously they have built up a business. All their blood, sweat, and tears have gone into that business. Typically, from what we deal with, would be South African business, and so they do want to then safeguard those profits from a wealth generation perspective. So they then like to structure through a foreign trust. So what you normally find is that they would want to have their SA company underneath a foreign structure such as this. All right. Now, a lot of the questions that we get is to say, okay, for example, my brother and I have started a business. Obviously, we're the 100% shareholder. So if we structure something like this, can we each hold 50% through our own foreign trust? Then we'll get the participation exemption. And unfortunately, the answer to that is no. Okay, so the 50% threshold for holdings through a foreign trust is for SA residents who are either alone or with connected persons. Now, unfortunately, siblings would be seen as connected persons. So SARS would then look at and say, okay, but you've got siblings who are beneficiaries of foreign trusts, which together hold more than 50% of the shares in that underlying foreign company. So then, unfortunately, the participation exemption doesn't apply. Okay, so unfortunately, we can't, just split. You have your mom and your dad holding in one, and you as a son or the daughter or even a grandchild holding into the other trust to split the shareholding to get the participation exemption. Unfortunately, we cannot do that. But if it is, let's say, 2 or 3 shareholders who are unrelated to each other, so they're just business partners, but they're not related, then we can split the shareholding through separate foreign trusts, and we can do some tax planning in that regard. Okay, so exchange control. So, we've spoken about if you have an offshore structure or a foreign trust, how do you fund it? So as we said, you could typically do a donation or a loan. So then the question is, okay, well, how do you get those out of South Africa? So you would use your exchange control allowances in South Africa in order to do that donation or that loan to the foreign structure. So I think, as everyone knows, we do have our single discretionary allowance of R1 million. That's per calendar year. It applies to all individuals in South Africa who are aged 18 or over. So unfortunately, minors do not qualify for the R1 million single discretionary allowance. On top of that, you do also get your foreign capital allowance, which is an additional R10 million. So essentially, over one calendar year, South African residents over the age of 18 can externalize R11 million from South Africa. For the R1 million single discretionary allowance, you don't need any approvals for that. You would just tell your bank, I want to transfer my R1 million outside of South Africa, and your bank will do that. Any amounts over R1 million, but less than or R10 million or less, you need to get a tax clearance via e-filing. You do need to then tell SARS the source of those funds. And as long as you've done that, you put in your application and then you'll get a PIN. So you get a certificate with a PIN number, and then you'll give that to your bank and then they'll transfer the money offshore. If you do want to take out more than R10 million, it's a little bit of a more protracted process. So you do your normal AIT application via e-filing. So you'd get a tax clearance certificate via e-filing, And then you would give that to your bank. And then unfortunately, your bank is going to do the whole process again for the Reserve Bank. So they'll ask you for the same information, prove the source of the funds. And only once then the Reserve Bank has then approved it as well, will the bank then transfer that money offshore. For your foreign capital allowance to get the tax clearance via e-filing, there's normally a 21-day turnaround time by SARS. They do normally stick to that timeline. They are generally fairly good with that timeline. For amounts exceeding 10 million Rand, it does take long. I had an experience with a client where it took, I think, about 3 or 4 months. So it can be quite a protracted and longer process. So if you do want to take out more than 10 million Rand, just plan ahead so that you do have enough time to take that money offshore. Okay.
Thanks, Vanessa. The next slide looks at the general risks that you need to be aware of when you're looking to externalize your business. Some of them we have discussed a bit earlier, the especially controlled foreign companies and treaty shopping we have discussed. Another very important consideration is place of effective management. So together with substance goes place of effective management, and we'll elaborate on that in a second. The second important consideration is transfer pricing, which essentially means, as we've briefly alluded to before, that any transactions between connected persons cross-border must be at an arm's length, which means that essentially it must be at the rate, if it's interest, for example, it must be at the same rate that two independent third parties would have contracted with each other. Then another big risk is the risk of permanent establishment. And that essentially means if you create a taxable presence somewhere or in another jurisdiction outside of the jurisdiction of incorporation of the company. So Vanessa, I think the most important thing, first and foremost, place of effective management, because if you don't have place of effective management in the right place, you could be, it could essentially trigger tax residency in another jurisdiction. So if you could please elaborate a bit more on place of effective management.
Sure. And so place of effective management, so from a South African perspective, for companies, a company is regarded as tax resident in South Africa if they're incorporated in South Africa or if they have their place of effective management in South Africa. So for example, if you are going to establish, let's say, a holding company in Mauritius, for example, if SARS is of the view that the place of effective management of that Mauritian entity in this instance is in South Africa, then that Mauritian incorporated entity would still be tax resident in South Africa. So place of effective management is essentially the place or the country in which the board of directors make the key commercial and strategic decisions for the business. Now, these type of decisions are your more board type decisions, but they don't always lie with the board of directors. So if you've got, let's say you've got that structure in place where you've got your foreign company in Mauritius and you've got a South African company underneath, if all the decisions around the Mauritian company are still made in South Africa, so even though you've got your board members in Mauritius as per Mauritian legislation, if you've got, let's say, 2 Mauritian directors on the board, but 1 in South Africa, and your South African director stays in South Africa and dials into board meetings, and he's the one making all the decisions, then your place of effective management can still be in South Africa. So your place of effective management is very, very important to determine. It's also quite a tricky concept because you can have more than one place of effective management. So you could have, board of directors all over the world. Then you've really got to go and say, okay, who's making what decisions? And, where are those decisions actually being made in substance? So you'd have to really dive down into the detail to now try and determine where is your sole place of effective management. And SARS has been known to go as far as looking at emails. They do tend to ask for minutes of board meetings. They do want to know who were at board meetings, how were decisions made, etc. So even if you're in a case where you've got the board of directors where you need them, you've got your minutes of meetings, but the board is just rubber stamping decisions that have been made previously in another jurisdiction, then you're still going to fall foul of place of effective management. And, you know, it's quite easy to, you know, when you first set up a structure, let's say you've got your main operating business in South Africa, you've got your holding company in Mauritius. For the first couple of years, very fun to fly to Mauritius once a year, twice a year, go for your board meetings, spend a bit of time at the beach. But after 3, 4, 5 years, you're now, oh gosh, do I have to go there again? I've been there for the last 5 years. I'm just going to dial in. And then complacency starts to set in. And now suddenly you've fallen foul of place of effective management, you know, because unfortunately that is human nature. So you've got to be very, very careful with place of effective management. And it's also not just something you put in place when you first establish your structure. It's something you do need to be aware of continuously, and that you do need to have checks and balances in place to make sure, you know, that you don't have a couple of years where, oh, you just didn't feel like getting on that plane. You've been there so many times, you know, and then unfortunately you fall foul of it.
Okay, thank you. And then transfer pricing, Vanessa. So we said that briefly, transfer pricing is applicable when transactions take place between connected persons cross-border. So I think a question that I want to raise to you is, if I have a parallel structure, in the sense that it's not just one consolidated structure, I have 2 separate holding structures, and those companies from those 2 structures transact with each other. Will they still be seen as connected persons from a transfer pricing perspective? And if you could just elaborate a bit on why that would be the case.
Sure. So the definition of a connected person for transfer pricing is extremely wide. There was even an addition made in the last couple of years to include associated enterprises in the definition of connected persons. So normally from a connected person definition, you would be connected if you have common shareholders, and at least one of the shareholders, I think, owns at least 20%. I'm not a transfer pricing expert, so excuse me if I get that slightly wrong. But essentially, there has to be normally has to be common shareholding if it's companies. If you've got trusts at the top, you could be connected if you have at least one beneficiary that's the same. But now it even goes, the definition goes further, and it brings in associated enterprises, which is not really defined in detail anywhere. But essentially, even if the 2 companies are managed by the same people, so even if they don't have the same shareholders, but they're ultimately managed by the same people, then they could still be seen as connected. So if you've got a parallel structure and you've got similar shareholders at the top or similar beneficiaries of trusts at the top, then those 2 structures will be seen as connected. So then any transactions that happen between the 2 structures will have to make sure that they're complying with transfer pricing rules. It's also interesting to note that Mauritius has, well, they've always had transfer pricing per se, but now they've brought in documentation requirements in Mauritius. And in Mauritius, you do have transfer pricing on domestic transactions as well. So even if you've got 2 Mauritian entities in the same group, you have to have transfer pricing in place for those entities. And there's a couple of countries around the world that do also have domestic transfer pricing. So even if it's not going cross-border, the transactions between those entities must be at arm's length. From a South African perspective, transfer pricing only applies to cross-border connected party transactions, but you do need to make sure that you do have all your transfer pricing in order for any of those transactions.
Thank you. And then just another important thing is permanent establishment. I think I'm just a bit wary of the time, so I think we could make it a nice, quick, short discussion. So,
yeah, so essentially, a permanent establishment is, for lack of a better way to explain it, like an unofficial branch that you've got in another jurisdiction. So if we go back to the example I keep using, if you've got a Mauritian holding company and a subsidiary in South Africa, if you've got, let's say, an employee who's running around in Namibia, for example, looking for clients and concluding contracts with those clients, then that employee could create a permanent establishment for the company in Namibia. So essentially, if you've got employees or people acting on your behalf in another country, and they're doing that on a fixed basis, which is generally more than 6 months, then you could have an issue or a risk of creating permanent establishments outside of your country.
And then the last one on this slide is the general anti-avoidance. So general anti-avoidance just shortly speaks to what Vanessa mentioned earlier, that your structure must be commercially viable. So what the general anti-avoidance rule says is that if you enter into any arrangement or transaction or structure or whatever the case may be, just for the sole reason of avoiding tax, then it will fall within the general anti-avoidance rules. And then certain benefits or tax exemptions or whatever the case may be can be disallowed. So, and I just also briefly want to mention that there was recently a case in SA law where it was actually decided in the tax court in SA that the general anti-avoidance rules does apply. And that was to a transaction that occurred in 2011 when there wasn't dividends tax yet and it was still secondary tax on companies. So it's a very important thing to also look at, that the reason for setting up the structure must be commercially driven. Let's go on to the next slide. Yeah, this slide, I think we already discussed this one in the place of effective management discussion. I'm not sure if you want to say anything further on this one, Vanessa.
No, so this is essentially just a illustrative picture of what I spoke about earlier. So even if you have 10 directors in Mauritius, for example, but one director in South Africa, and the South African one is the one calling all the shots, then you could still have a place of effective management risk because of that. Yeah, I think briefly, if we could just jump to so the last two slides, I think some of you might have seen in the market, there's a lot of talk at the moment about trust-to-trust distributions. So previously, South African trusts were never allowed to make a distribution to a foreign beneficiary. Very quietly, this was changed. Suddenly, there was just a notice on SAR's website clarifying that these are now allowed. But it's only been within, I think, the last year that it's really started to take off. So if you do have an existing South African structure, which is ultimately owned by South African Trust, if you've got cash sitting in that South African trust, it could be a very, very nice way then to fund that offshore trust. So what you can do is the cash that's sitting in the South African trust, you can then fund your offshore trust with that cash by way of a normal trust distribution. There's a couple of requirements you have to meet for that. One of them being that the foreign trust has to be a named beneficiary of the South African trust. So you may need to go back and amend your South African trust deed. But as long as it's a named beneficiary of the trust, you can then make distributions to that foreign trust. Now, in order to do that, again, because the South African trust is an exchange control resident, you do need exchange control approval. So as like an individual, you're going to need tax clearance. Unfortunately, for a trust, you can't do that through e-filing. It is a manual process you have to go to through SARS. So you would go to SARS, say, my South African trust wants to make a distribution. What SARS would then do is they are going to audit the South African trust. They want to make sure the South African trust has paid all the tax it should. They want to know the source of the funds as per normal. And once all those boxes are ticked, then the South African trust can make a distribution to the offshore trust. The nice thing about this is that, as we mentioned earlier, when an individual normally funds an offshore trust, you've got to be very careful of how you fund it so that you're not triggering the attribution rules. But when a South African trust makes a distribution to a foreign trust, it's a distribution. So it's a trust distribution. It's not a donation. It's not a settlement. All right. So your attribution rules then don't come into play. All right. We know that cash is allowed to be distributed through this mechanism. It is unclear if you're allowed to distribute assets through this mechanism. SARS is a bit silent on that, and it hasn't yet been tested in the market as far as I'm aware. The other thing we've heard that people are doing via this is the SA company is making a loan to the SA trust, and then the SA trust is taking those funds offshore. Now, I'm not sure if that would actually be allowed, but if anyone's done that and it has been allowed, I mean, we would be interested to hear that. But we have heard that people are trying that option as well. All right, so I think this is just to show that this is a very nice way at the moment. If you do have existing SA trusts and you want to get those funds offshore, it's a very nice mechanism to do that. A bit of compliance to go through first, but once it's offshore, it's nice, free and clear, and you don't have to worry about attribution rules anymore. Okay, and then the very, very last slide is just to say, if you do have an existing SA structure, and let's say you've got a South African company in South Africa, which is worth a lot, but you would want to get it under an offshore structure somehow, you can make use of a Section 42 transaction to move the shares in that SA company offshore. Now, I think, as most people know, a Section 42 transaction is quite involved. There's a lot of boxes you need to tick, and there's a lot of things you need to make sure that you meet in order to do it. If you do it right, it's a very, very nice structuring mechanism. I'm not going to go into detail on this now. We do have a webinar in November that specifically deals with structuring using a Section 42 transaction. So if this is something that you think could work for you, or you want to hear about it in a bit more detail, we are having a webinar. I think it's around the end of November, specifically talking about Section 42 transactions. So that is it from our perspective. If anyone has any questions, please put them in the chat. Otherwise, you're welcome to reach out to either myself or Marcel if you've got any specific questions, or if you want to chat about anything in more detail. All right, thank you so much for your time this morning. We do appreciate it, and we will be sending the slides around. I think Kudwano did say that, but if anyone needs anything further, please just let us know. All right, perfect. Thank you so much, everyone, and enjoy the rest of your Wednesday.
Thank you. Bye.